All right, what's going on in options? So short gamma is well and truly back. So if we look at the S&P, we obviously slid last week down to quite important support levels, 43 to 43.50 area. The 100-day and 200-day moving averages are not far away now. You can see on here, we've got this on the futures. They're quite, I mean, they're probably about 3 to 4% away to get to the 200-day moving average. So not a million miles away. A CTA flush, as we've been saying, could very well be on the cards as these kind of key trigger levels get breached. These CTAs are for sellers. They're not price sensitive. They're price sensitive, but they're not emotional. So they're just going to sell what they need to sell, and it could be in the tens of billions of dollars. And that will clearly have some market impact. The US government shutdown is obviously looming as well. 1st of October is deadline here. We'll see what happens there, but the market's unlikely to rally until there's some sort of resolution from that as well. Now, if we could look at what Spot Gamma is saying on the gamma positioning side, they've got their put wall here at 4,300. There is also a big strike here. So these big blue bars represent large put open interest or large put gammas. And the 42.10 area is a big one because that's the JP Morgan put spread collar strike where JP Morgan have bought the 42.10 puts. So normally when the market's not doing a lot or gravitating to the upside, the market tends to go towards the JP Morgan call strike, which JP Morgan have sold and dealers have bought. And what tends to happen is the market gets pinned into that expiry into quarter end because everyone's choking on that long strike and bleeding time decay and are forced to trade the market in a very tight range. Now we're going towards the JP Morgan long strike where they are long the put, the market is short. And that is in $20 billion notional. So that is creating quite a lot of gamma, particularly if we go down to 4,200 within the next couple of days. That is going to be the largest amount of gamma there possible. And the market generally tends to be short downside gamma anyway. So these 43 put area where we've got a big put position is probably already short. There's shorts coming from 4,000. There's shorts coming from 4,100. But we know for sure this 4,200 one is a big one for this Friday. So the point being is if the market is in the vicinity of 4,200, then we would expect extreme choppiness. The S&P is going to be winging around like a madman because the dealer community is going to be dealing with a very, very large amount of short gamma on its books. Okay, and that's just going to create a lot of chop. And then after Friday's expiry rolls off, then that chop is going to subside and calm down a bit, basically. So if we do go another 100 points lower, expect there to be quite a bit of intraday volatility. Now, what we'll also get on Friday is we'll get these guys rolling their position into a end of December put spread collar, which will supply a load of Vega to the street, somewhere in the order of magnitude of 5 to 10 million Vega. I can't remember the exact number, but let's call it, I don't know, 8 million Vega, okay? If the street's getting supplied with all that Vega and the short gamma that they're dealing with is rolling off at the same time, then that is very much going to heal the market from extreme volatility. So whilst we might get a lot of volatility into the end of this week, I think it's very possible then we're going to suddenly see that volatility drop off next week. So even if the market makes lower lows next week, it might be that the vol just can't really do a lot because everyone's been stuffed in a load of December Vega and the kind of height of the selling from CTAs is all done with, so the market can kind of calm down. So that's kind of the setup I'm looking for. I'm looking for weakness into the first half of this week. Maybe we get really choppy into Friday. Vol kind of reaches a crescendo and spikes at some point this week. And whilst we'll make a new high in vol this week, maybe the VIX will see a 20 handle. I think next week, even if the market goes lower, the vol would have actually topped out. And that will kind of be your signal that, okay, time to start looking to the upside for year end. Okay, so that's how we're looking to play this out. We're going to try and exit out of our long vol positions throughout the course of this week into any vol spike that we get. And then we will probably be, if we did get that sort of VIX spike into the 20s, we'd be looking to set up short vol and long delta type strategies looking out into November and December. Okay, so we look at the chart here. We've been flagging, right, the seasonal period of weakness, late September, early October. So it does seem to be playing out like clockwork right now. Technically, we're kind of carving out this ABC type correction, similar to what we pointed out on NASDAQ last week. So right now the market's here. It's still in a uptrend, so the uptrend is still intact. So we could get down to 420 on SPY, which is like 4,200, and the uptrend's still intact. I mean, we may breach it as well, but right now, I mean, it's pretty clear that uptrend has not been broken. In terms of timelines, you know, I've got October expiry and December expiry on here just to kind of show where they are on the chart. So I could definitely see, you know, weakness extending close to that October expiry, or maybe we start to bounce, but we don't really have a material bounce until after that's gone. So that's why we kind of think calendar structures might be sensible, where you kind of buy December calls, but you sell October in front of them, because this correction needs to kind of play out and do whatever it does before the rally comes, but the rally could come after October has rolled off. Okay, so that's kind of what we're thinking, and it looks like the technicals are lining up quite well from kind of, you know, the seasonality and the trends, etc. Okay, so looking at the dashboard, S&P is looking a bit oversold, obviously, below the lower Bollinger Band here. So we're landing sort of between bullish risk reversals and buy calls. Bullish risk reversals are basically selling puts against buying your calls. We're not a massive fan of that because these are quite important levels, and if they break, like I say, there could be an acceleration lower due to positioning. So we don't want to be exposed to being naked short puts right now. So then the way we kind of like it is calendars. The carry here is positive, which is another reason why you don't mind doing a trade that's actually collecting theta, not paying it. You can see the front end has popped materially here. So you've got the front end October stuff here at 15 vol, but then the back end is actually the December stuff is similar sort of vol levels, right? So the fact that you can get into that vol spread October versus December at close to flat vol is quite attractive. And like I say, especially when we've got a positive vol carry there, because the S&P isn't moving enough, right? So we do think if we get a bounce in the S&P, this front end is going to collapse straight back down, and therefore your October, December will work in terms of from a vol perspective. And that's why, you know, we would do a trade that is slightly long delta, but remember, not too long delta, because if the market does puke from here, we don't want to get too hurt. But if the market does drop from here, you're going to be able to buy your October calls back. And, you know, and if the market grinds slowly up from here and doesn't really smash back through your call strike in October, then you won't, then your call calendar will behave itself, right? So the type of call calendar, if I bring it up here, that I'm looking at is on the SPY.